Hi, thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew. This is another earnings conversation. We're speaking with the management of Westlife Foodworld. And it was a strong quarter in the first quarter. It posted a PAT growth of about 22%, with revenues going up as much as 14% and margins growing across the board. We'll talk about some of those details in more granular terms with the management. Akshay Jatia, Executive Director of the company, is joining in. Akshay, thanks so much for taking the time. Let's start with that sales growth. What can you tell us about what led to that 14%? If you can give us some more details there.
Thank you so much for having me. So, we're very excited to talk about the quarter that just went by. Obviously, macroeconomically, you're seeing headwinds and, consumption is slowing down across the board. But we're very proud that we were able to deliver differentiated results. And that means, 14% plus sales growth, 7% SSSG. So we maintained our guidance around high single-digit SSSG. A lot of this has come on the back of our foundational strategy that we continue to talk about: burger, chicken, coffee. We launched our mixed spicy peri peri paneer promotion back in April, and it was probably one of the most successful launches we've had in the recent past. Not only did we kind of launch at the higher end of the spectrum in terms of a kind of premium burger, we also launched our Big Saver meals at a flat 179 rupees, and that's also brought in a lot of customers to our restaurants and is continuing to kind of attract walk-ins. Secondly, we also launched a very exciting promotion with NTR Junior in the South, and it's all around our chicken buckets. Our chicken sharers, which are kind of buckets of chicken pieces in different combinations. And because of this product already having resonated so well with our customers and doing such a strong collaboration with such a strong name, we've further built our brand relevance and product market fit. So these are the key highlights of the quarter, and some reasons as to why we were able to do the numbers we did.
I'm curious about how the quarter was in terms of the trends that you're seeing in metro versus non-metro, because I believe from your numbers that the non-metro is doing better or is growing faster than metro right now.
So for us, it's about broad-based growth. Non-metros, do tend to do better as you continue to open new stores, penetrate, because the opportunity is just larger. And metros like Mumbai already penetrated quite well. However, even in Mumbai, a lot of the stores we're opening more recently continue to clock numbers that are so impressive that we're going to continue to sustain our market leadership in Mumbai, and we're also going to continue to penetrate these tier 2s, tier 3s, as well as small towns.
Okay, fair enough. I see margin expansion, and I referred to that at the start. Gross margins improving quite substantially, EBITDA margins as well improving on a year-on-year basis. What has contributed to that? Is it, and I think we spoke about this the last time as well, the fact that you have McCafe is now in over 80% of your stores, and that's kind of leading to that pop in margins, if I'm not mistaken?
No, so gross margin for us has improved, like you said, 235 basis points this quarter. We're very happy with this improvement. Restaurant operating margin has also come in very strong. But for us, it's not only about gross margin, but we have multiple levers to kind of manage our margins. Number one is, through having very strong supply chain, ensuring that in periods where inflation is coming down, just like it did in this last quarter, we're able to kind of optimize our costs and reap the benefits of our long-term relationships and strategic sourcing. Secondly, we do kind of take price when required. So last year, when required, we took the right amount of price, which did not impact, customer walk-ins, as you saw in this current quarter as well. And lastly, we have a very strong product mix ranging from premium burgers to beverages to chicken, and strong cost governance measures, which allowed us to deliver very strong operating profits as well.
Okay. It's interesting that you point out what you just did, because we're talking a time when in this quarter, ongoing quarter, you're going to see quite a bit of pressure on the cost side. It's been widely covered. One of the key ingredients in the meals that you serve is going up quite substantially. How are you dealing with that? Is that going to lead to pressure on the margins, or do you have measures in place that will curtail that?
So, we deal with this every year. In fact, last year was the worst year probably you've seen in the last decade, and we were able to kind of manage our margins very well. So, these fluctuations in commodity prices and, like raw materials like tomatoes, for example, they come and go, and they never really impact us in terms of our margins because we have long-term contracts, we have strategic sourcing in place. So we don't kind of source from the regular market like a lot of other people do, and hence they kind of talk about this a lot more. So we continue to maintain the guidance that we plan to deliver 18 to 20% EBITDA margin over the next 3 to 5 years. This last quarter, we've done around 17.1% post-Ind AS, and that's on the back of gross margin expansion.
Interesting. All right. So I take that point. In terms of store addition, you're planning to be quite aggressive this year. 4 you've added in the first quarter, and I believe 40 or thereabouts for the full financial year. What is the kind of geographical spread that you're planning?
So, when we spoke about our Vision 2027, and for us, it's a long-term plan. While this year may be, a little up and down in terms of what I'm just going to say, our long-term plan is based on, 2-3 key insights. Number one, South is doing very well for us. Our product market fit and brand relevance is strong. It's a little under-penetrated because, we penetrated the West very strongly first, and we're clear market leaders here. In the South, we're now kind of moving towards market leadership, and we have a very strong opportunity to double down on the number of restaurants we have in the South. So South is an area where we're going to continue to penetrate. Number two, smaller towns. And we spoke about some case studies of drive-thrus in these smaller towns, like a town in Gujarat called Bharuch, where average unit volume is even higher than our average for the system because of the fact that McDonald's is a destination, and we open these large format restaurants where customers love going. They find it very convenient. It's a destination for them and their families. So, 50 to 60% of our new stores are going to be in the South, as well as in these smaller towns and tier 2, tier 3. And lastly, drive-throughs. I spoke about drive-through as well in this example, that drive-throughs allow us to drive volumes. And drive-throughs are going to be a key focus for us moving forward. And 20 to 30% of our new stores are going to be the drive-through format. So this is our kind of insight-based new store expansion strategy.
So Akshay, I'm probably asking this for a lot of people who are wondering this. You've got 3 primary ways in which to sell the food that you make, right? You have your in-dining experience, you have the drive-thrus, as you pointed out, and you have delivery, or you have off-channel. In terms of the business, of course, all 3 are important, but in terms of the business and in terms of what it means for you, what is the best way for you to do business? In terms of what is operationally the most lucrative way to do business, and how do you nudge people towards that?
So I think for us, because we are multi-channel, multi-category, all growth is broad-based for us. Obviously, certain channels might have some better metrics, but overall, I think they all add to the pie, right? And for us, it's about growing average unit volume. It's what the customer wants. It's not about whether delivery is less profitable or more profitable. Dine-in is more profitable or less profitable. It's about where the customer is and what type of experience we offer them across channels. And that's a personalized, omni-channel, convenient experience. And as long as we continue doing that, we're going to drive average unit volume. And because of the way our business model is set up, when we drive average unit volume, it results in more profits. So it's about addressing customer needs for us.
So, okay, let me ask that in a different way. If more people come to your stores, come and sit in your restaurants and eat in, does that reflect well in terms of margin expansion, in terms of profitability?
So I won't talk about margin expansion and profitability, because I think what's more relevant is that it reflects well on the brand. In fact, getting a customer to come to a physical location and consume over there is the hardest thing to do in an era where everyone is on digital, right? So in fact, I would say that's great, because customers are wanting to come to a McDonald's, wanting to sit at a McDonald's and, spend their time there.
Okay, so you've already pointed out in terms of store, the plan for this year. What is the capex like? How much are you going to spend setting those up?
So, we've spoken about the next 5 years, which is around 250 to 300 restaurants, a lot of kind of modernization of our restaurants too. So around 14 billion plus rupees being spent in the next 5 years on capex. This coming year should be similar to the year that went by, which is roughly around 200 to 250 crores in capex.
Fantastic. Akshay, always a pleasure speaking with you. Thank you so much for speaking to BQ Prime.
Thank you, Alex. Really enjoyed it and looking forward to doing it again. So.